Hi, everybody. Thanks so much for joining. I know I wasn't at this webinar on Monday, so I do appreciate you coming back. But anyway, I hope you're all well. Big day for us here at Forex.com because it's the release of our Q3 Outlook, so do watch out for that. It's going to be on our website later today, so 8:30 Eastern Time, US, so that's about 1:30 UK time. So do watch out for that, get all our ideas. But looking at things, firstly starting off, just kind of since I've been in the market, since I've just been in this morning, a bit of a risk-off start to the day. There's obviously you know, in terms of economic data today, there's not too much out there. We got the minutes obviously from the FOMC meeting. That's a big deal. But that's this evening, so that's at the end. For the European session, there isn't too much. There's German consumer prices. That's going to be kind of important. We'd expect them. You know, they came out at 7 o'clock today, and they declined yet again. Obviously, they'd kind of been through they're the final June figures, so we already knew that German CPI was weak. But looking ahead today, there isn't too much out there. There's a trade balance for the US, could have narrowed a little bit. But other than that, you know, we're kind of being moved. You know, the markets are very jittery. They're very, very skittish. Okay, let me just put on just bear with me one moment. I'm just going to grab up a chart. Just bear with me one moment while I just pull them up. Okay. Right, so this, hopefully you can see this pointed figure chart. I'm just actually updating it, so let me just restart that. Here we go. This is an very short-term pointed figure chart, and right now this is euro dollar, and I'm looking at euro dollar because we're kind of in the environment whereby, you know, the markets are just trying to settle down. You know, it seems to me we're on the cusp of maybe kind of another leg lower across risky asset classes, and I think that if that happens, we'd be led lower probably by the euro. So right now what we're seeing is consolidation, and there you have it. That to me is consolidation before another leg lower. And the reason why I think that is because economically and politically things in Europe are still very, very weak. I mean, you know, we've got the ECB cutting rates, obviously. We've also on the other side of things got you know, problems on the horizon with Spain, with Germany now delaying things. I mean, I wrote a piece yesterday, and it was how Germany was supporting the gains in the euro dollar. So, you know, all of the gains in the euro anyway. So all of this is really keeping us trading sideways. So as you can see here, right now, you know, what's holding on? 122.60. However, we do think the bias is lower. So we'd look for, you know, just some, like, obviously 122.50, 60, then 122 kind of 40. Below there, we think that we'd probably see 122.10, then maybe 121.50. Obviously on the way, which then opens the door, of course, to 120. Our range actually for the third quarter is 120 to 127. Now, that doesn't necessarily mean that there won't be a move lower to 115. Our caveat is that there could be a move lower to 115 if we have some sort of disorderly issue in the currency block. And even though our range is quite wide between 127 and 120, we've still got quite a bearish outlook. Apologies. And the reason why is because, again, as I said, economically and politically, we don't think the currency block is here, or the single currency is looking very strong. However, we have got a slightly if things can remain fairly kind of stable in the overall or the overall environment of risk for or the overall in the sovereign debt crisis, if things can stabilize there, then we think we could see kind of a bit of a recovery. And we wouldn't be surprised to see the euro actually end the year a bit stronger, namely because, you know, a lot of bad news is priced into the euro already, and yet what we're seeing is some real weakness coming out of the US economy. Don't necessarily think that's priced in yet. However, that's kind of our more longer-term thinking. Our short-term thinking is that we are consolidating, getting ready for another leg lower towards that 120. So we could actually hit the bottom of our Q3 range quite soon, sooner rather than later. Obviously, on the upside, then, that's what I love about point of figure charts. You can see it so clearly. 122.70. I would need to clear there to be able to open the door to 123.25 to start with, then 123.65. Obviously, this is the 123.35 level, 25.35 level that we're talking about here. So it looks ages away from where we are right now, but of course, this is a very short-term chart. So do look at that. Now, bear with me one moment, because I think sometimes it's always easy to look at the longer term. So this is the historical chart. This goes back a year, and as you can see, just completely leg lower, leg lower, leg lower. But it's where do we base? So in the short term, yes, we see things being, we do certainly see some more weakness, but in the longer term, there could potentially be, some buying interest around 120. And if not 120, then we could easily get down to 115, and again, that could spark some buying interest for sure. Okay, someone's asked very patiently if they can look at cable. We can. Bear with me one moment while I just update my chart. Sorry, I've got a bit of a cold at the moment. Right, so this is cable. This is the cable chart. This is point of figure as well. I'm going to go through the point of figure, and then I'll go back onto my normal chart, the one that I normally use, just so that you guys can take a look at specific other indicators that I use. But every so often I go through bouts of really wanting to look at point of figure charts, and I'm going through a point of figure bout at the moment. Okay, so what we've got here, as you can see, cable, long term. Talk about range bound. Middle of its range, slightly weak within its range, really, its long-term range. So that is kind of up to all the way last year's 166 highs. Obviously the lows then being kind of 152.50. We seem to have backed away from there quite nicely, currently kind of around that 155.50 mark. But obviously, where we are now, 155.50, major level, major support zone, a breakthrough there could easily see us get back towards that kind of 153.50. So do watch out for it. Now, just bear with me a moment. I'll look more at the intraday. And the intraday chart is actually very interesting. As you can see, it's kind of been moving higher. It hasn't really been making too much traction. But we've certainly backed away, we're certainly kind of towards the top of that range. Just bear with me one moment. We think kind of, look to buy potential on any strength below 155. So, if we were to dip below, say, maybe back towards that kind of 155.15, 155 area, then we could potentially move higher. And the reason why I say it is that overall, in the long term, obviously that's kind of weak, and it could suggest an opening down to 153.50. But in the short term, we seem to be consolidating a little bit. So again, there's I know that I've seen one trade recommendation. I can't remember who it's from, maybe Trader Central, that was saying get in at 154.95 and just make just aim to make 100 pips really, and that seems about kind of fair now as well. So really, kind of on any dips towards kind of 155, the figure potentially just ride that storm a bit, because we do seem to be trading in a bit of an uptrend here, as you can see. Or we're still within kind of an up channel, even though we all know kind of the problems. But cable really hasn't been affected in the same way that euro has. It's been fairly resilient actually, and partly that's because whenever there's problems in Europe spring up, it does drive safe haven flows into gilts as well, and that does help prop the pound up, even against the US dollar. But as you can see, pound been quite strong, and just bear with you a moment, because I'm going to look at the cross now, because that's been particularly interesting, and that would be another reason potentially why cable has done well, is that euro sterling is at kind of multi-year lows now, down below that kind of 17, or has tested below that 79 level. Obviously is now kind of just testing it right now, 78.95. We thought in the short term anyway, this has actually fallen much sharper than we thought, or much faster at a faster pace than we thought. Now we are well with it. We think our range is good. Our range is 75 to 82. in euro sterling for this quarter. But one thing we would say is that it does seem to be moving there quicker than we thought. So as you can see here, obviously, we're at historical levels, 78.90. 78.90 is a big level, big support level. We're testing that now. Below there, you're looking at kind of 30. You're looking at probably 30, 50 pip moves to the downside. We've seen some very big moves. Obviously, we did see that big move earlier this last week, lower in euro sterling. But what we could do is kind of how euro sterling tends to move is that it does tend to be quite choppy. It tends to be quite choppy, but actually usually it can move in a so have a big sharp move and then move sideways, big sharp move then move sideways, and can look quite choppy. So if the eurozone crisis stabilizes in any way, the caveat to this, if the eurozone crisis stabilizes in any way, then we could actually see this pair snap back, and just some levels to watch. Obviously, is kind of 79 the figure. Then we're probably looking at, looking all the way back towards that kind of 79.15, 79.30, all the way up to 79.50. By and large, we do think that it's, certainly got a bearish bias, hence our 75 to 82 range. But as I said, in essence, if we don't get kind of complete capitulation, then what we may get instead is kind of moving sideways with a slightly bearish bias. Okay, just bear with me one moment. Someone's asked me to look at euro yen, and I will. I'm going to look at it in the same way here. So euro yen, obviously, kind of big week coming up for Asia, Asian currencies. We've got a lot of data coming out of Australia tomorrow, and then we've also got China and its GDP coming out on Friday, and also tomorrow we've got the Bank of Japan meeting. So there is a chance of central bank intervention. We think they will do it. We expect 10 trillion yen. Will that have an impact on the yen? So this is the long-term euro-yen chart. Very, very weak within its long-term range. Not back at those 96 lows, but looking fairly weak around that kind of 90, below 97 mark. It's not looking fantastic. Let's take a look at it on just a shorter-term basis. As you can see there, very, very, oh, you can't see there, sorry. As you can see, this is euro-yen on a week-term basis. It's broken out the bottom of its range. It's looking weak. It's consolidating a little bit, but the range is actually narrowing. And when ranges narrow, as you can see here, that tends to mean that we're going to break out one side or the other, certainly in the short term anyway, because this is a very short-term chart. And we wouldn't be surprised if we were to break out to the downside. This pair is your ultimate risk, your ultimate kind of risk, your ultimate risk trade at the moment, what with Euro Swissy being kind of capped by the SMB. So there is a lot of residual fear out there about Europe, a lot of residual expectation that the problems aren't yet solved. That is going to have a kind of a bit of an impact, and for us that means kind of further weakness. Now, obviously, getting down towards those kind of 96 level, that is a key, that is a historical low for this pair. So we are getting close to some very, historical levels. Does that necessarily mean we won't breach them? Well, of course we could. Obviously, there could be a bit of trepidation now between now and kind of 96 on the downside, but that doesn't mean that we won't necessarily break through it, because this pair is acting as your ultimate risk pair. Now that, as I said, the Euro Swissy is to the side, whereas other pairs, Euro dollar is moved around a bit by what's going on in Europe, by what's going on in the US as well. It's the same with Euro sterling to an extent. Euro yen is really, it is your proxy for risk at the moment and risk appetite. So risk on, it's gonna recover a little bit. Risk off, you expect Euro yen to decline. And as I said, currently 97.34. Well, the first hurdle to climb on the downside is obviously 97.10. Okay. Someone said, can I explain the yen numbers? I assume you mean kind of the legend down the side. So yeah, how pointed figure works is that it basically strips out time. As you can see here, no time. It's just pure price. These are just kind of your prices. The red and green boxes, if that's what you're talking about, is obviously green is for any kind of update. So each box represents kind of a block of space, and each as you go up, and each, obviously the cross is up, the 0 is down. So you see that. Just bear with me. Someone's just asked questions to look at the historical chart. I'm not 100% sure what you mean. They want to know what the 1 to 7 means. I can't really see that in this chart. Oh, sorry. Yes, what the numbers mean. What they basically do is they just point a figure. They just you kind of count important lows. So that's 6 there, and then we went back to 7. So it's counts. So it's a bit like a kind of a wave theory. Okay. So is it that? I mean, that certainly is kind of important. But for me, point and figure, this is a bit too long term. You don't do that on the shorter term ones. Okay. All right. So also you can look on our website because we have an evergreen piece about point and figure and what it means as well. Okay. Someone's asked me to look at gold. Bear with me one moment. I'll just pull up my other chart to look at gold. Gold has been interesting. It's managed to get its groove back a little bit after falling as low as we're on the 30-minute here. So this is a 30-minute gold chart, very, very short term. Bit of recovery in gold. And interestingly enough, we have seen a little tiny bit of recovery in euro yen as well. So that could suggest that even though we've had a very weak start to the day, we could potentially start picking up. So again, as I said, markets are very jittery. They're pretty much range bound. Just because we had a weak start in stocks and kind of in, euro dollar came off a bit, doesn't necessarily mean that we won't recover. And gold is really leading that mini recovery, if you like. So, I'm thinking about kind of in this environment how it's, how in these markets, you need to kind of, I think anyway, kind of limit your time frame a little bit. Obviously this is, a sharp decline, yesterday or the day before, a couple of days of declines. That's been mirrored by kind of what's been going on in stock markets. Since then, kind of recovered on the back, on the back of, a few things brushing off, news about kind of the, Germany delaying the courts, maybe concentrating more on the Eurozone finance ministers meeting and 30 billion going to Spain. So that's all quite interesting. Obviously, 1580 now is a big resistance level, certainly in the near term. But just looking at the RSI there, if I just drag your attention down here, that's looking fairly good and still suggests there's some momentum on the upside. Now let's take a look at the slightly longer term chart in gold. Gone through the 21-hour moving average already, and again with the RSI still pointing upwards. So it does suggest 1565 is a bit of a temporary bottom in gold for now. There's a lot of resistance on the way up though. 1580, 1590. And then you'll obviously get towards your 1600. And just on an hourly chart, that 1600 level looks like a really nice double top. So that is going to be tough to break. So we could be range bound a little bit, but we do think, just looking at the momentum indicators, that there is some more momentum on the upside. And of course, to start with targeting, we've got to get over 1580. If we do that, then there's 1585, 1590, and then maybe a retest of that 1600 level. Let's also look at it from a daily chart. As you can see, still very much range bound. So, the more you kind of stretch out your time frames, the more you see that, what we're seeing right now is a mini recovery. The overall direction is still fairly range bound. We're still lower on kind of a very long term basis. We're towards the bottom of that range, but we are most certainly range bound within the gold price at the moment. Okay, someone also asked, or I'm going to also look at silver as well, because silver was at a really key level last week. So let's just take a look at it there. This is a weekly chart, a really long-term chart. It was all the way down to kind of, that 126 level is a massive, massive support level. Now, it has managed to hold that level. Let's just take our time frame down a notch. Obviously, kind of, it looks, 126 is a really key level. It held earlier this month. It looked at one point on like Monday, Tuesday, as if we were going to kind of dive lower again. We didn't. We managed to kind of break back higher. and find some support. But that 126 level is really the key support level there, and that's the one to watch. Below there it really opens the way to 120. Oh, sorry, down to 20, not 120. So 26 being the key level, 20. If we get below there, it opens it up to that. Now we could be range bound between kind of 126.50, maybe 127.50 as well. Pretty much, that looks like a cluster of tops there at 127.50 on a shorter term basis, on a kind of shorter term chart, so on an hourly chart. That is going to be quite difficult to break above, we think. And right now, there isn't really any fundamental drivers to break as higher or lower. Certainly not kind of in the short term. But as I said, very much in consolidation mode right now. We are recovering, but as I said, we saw with Euro Sterling, we saw with Euro Yen. Yes, we may be recovering just in the very short term, but the range is actually narrowing. And that is slightly concerning and always something to watch out for then. When your range narrows, it suggests we could get ready for a breakout to one side or the other. Now, what we have seen in the last few weeks has been, or the last few months certainly, is that commodities have really led the way. So, watch out for gold. If gold starts to turn lower again, do watch out for it, as it could suggest kind of broader losses for euro and for stocks. Now, there is something else I want to show you. Just bear with me one moment. I want to show you the gold-silver ratio because I kind of really like looking at that, and we're getting close to some important levels there. Sorry, guys, just bear with me one moment. My charts are playing up a little tiny bit. Okay, so let's get here. Right, so this is a longer-term ratio, basically. So it's the gold-silver ratio, so it's just, gold divided by silver. And what you tend to see, it's a really good proxy for risk because in the when you get periods of major risk aversion, silver tends to underperform gold, and you tend to see massive spikes higher. Now, this is obviously, by and large, this kind of trades in a bit of a range, really, between kind of 50 and 70. When you spike above it, it suggests that risk aversion is taking hold, hence Lehman Brothers and that whole crisis there. When you strike below it, it suggests, we were in recovery mode there. However, the recovery kind of ended around 2011, and that was reflected in, the first quarter of 2011. We certainly did see a slowdown from there on, and it's just moved higher and higher. Now, the one thing that we're really watching for this quarter is whether or not this ratio gets back above that 70 level. So we're currently just below 60, so we've got some time to go. It doesn't suggest we're in panic station mode yet, but obviously, it is worth watching out for this. We want it to be, you really want this ratio to turn lower. Not much resistance now between now and kind of 70, so if you continue to move higher, it does suggest that the outlook is quite weak for the global economy generally. Largely because obviously silver is a very industrial metal. It's got more industrial usage. It's got higher correlation to the overall economic cycle, and that's certainly something to watch out for there. So take a look. So do watch out for that, and do please take a look at our Q3 outlook. I think there's good stuff in there. It's going to be on our website on the latest research page from this afternoon London time. But that's about it from me. So if you've got a question, I'm happy to take a couple. I didn't give a dollar CAD prediction, so someone's asked for one. So let's take a look at dollar CAD now. Bear with me one moment. Okay, so this is dollar CAD. Dollar CAD has been an interesting one, really. It's range bound because it's acting a bit like a proxy for risk. As you can see here, 102 is a massive support level, certainly on the very short term. Below there is a cluster of moving averages, so there's a lot of support. If we do see kind of a continued bout of kind of dollar or a more prolonged period of kind of dollar weakness, then we could see, that there is certainly a lot of support on the way down to 102.50. Obviously, right now, it does seem like kind of this 102.30 level, that's a real cluster of tops there. So the temporary top has been put in dollar CAD. With kind of 101.50 on the downside, but as I said, lots of resting support between there. So we could just trade in quite a narrow range. Dollar CAD is weakening on the back of that recovery and overall risk, but especially in oil. When you look at dollar CAD, I'm just going to pull up the oil price as well. I'm going to look at Brent purely because, well, both Brent and they're all moving together. However, let me just bear with me one moment. So here we go. Here is this is Brent chart, but also Brent is open right now. So let's take a look at that. Really backing away from that 100 level, but we have recovered quite nicely. 97.30 seems to be the downside. That seems to be a temporary bottom that's held really nicely. We could retest that 100 mark, and that's going to be good news for the CAD. Bad news for dollar CAD. Let's just go back there. Let's take a look at just the dollar CAD on a daily basis. As you can see, nice uptrend. Does seem to be 101 held as very good, kind of slightly longer term support. The RSI is still pointing. The RSI is still pointing kind of neutrally. The recovery in dollar CAD, is kind of more your longer term trend. Like we've seen elsewhere, like, we're getting shorter term bouts of weakness in the dollar, but in the environment, the dollar is still very much your safe haven of choice. With your Canadian dollar being a bit of a risk asset. So on a longer term chart, what you're seeing is a slightly different picture whereby the dollar still looks fairly strong. On a shorter term basis, of course, we're getting the opposite. We're getting kind of some weakness coming through there. Just as overall, because it just shows that, the markets are moving in and out of risk appetite. But, do watch for those narrow ranges. If that range narrows and we actually get a narrower range than, say, 101.70 to 102.30-ish, that's a narrow range and won't last. That's about the only thing that we do know, that when your range narrows, it means we're popping with one side or the other. Event risks to look out for this week. Obviously, there's the Fed minutes tonight. There's the Fed minutes tonight. There's also the Chinese data. That's going to have a big impact possibly on commodities. So even though we have been prepped a little bit for some weakness in that GDP report, which is released 3 a.m. Friday morning London time, it could be a bit worse actually. Certainly could be some weakness there. Okay, everybody, thanks so much for joining. I'm going to leave you now, but do look out for our Q3 outlook, and I hope this is useful, getting you started anyway on what is a fairly mixed but consolidatory day in the market. So thanks very much, everyone.